The New Orleans Conference, the world's greatest investment event.
Man, that last panel, that killed me. My God, I wanted to get out of here on a plane as fast as I could. Usually I'm the most bearish person in the room. I think on that table I was the most bullish, but it was an honor to be on that panel. It's an honor to be in front of you folks here. And we don't have a lot of time, so when I typically speak, I like to tell just a little bit about myself. I think it's important for the audience to sort of know who you are and how you're wired. I'm the oldest of 5 kids. My mom and dad met in 1960, the first day at law school at Fordham University. My mom was one of five women in that class. And on the first day of class, the professor looked at her and said, why are you here? Looked at another young lady, why are you here? If you're here to meet your husband, you're in the wrong place. This is 58 years ago. Well, my mother and those other 4 women graduated from law school, and they all went on to do amazing things. My mom took the bar exam in March of 1964, having given birth to me in December of 1963. I mention that because I think I'm sort of wired the way a lot of you folks in this room are wired. I don't take anything for granted, and I'm always sort of pushing, and I don't allow people to define who I am. I learned that sort of from my mom. She wasn't going to be defined by that professor, nor were those other 4 women, and you know what? I'm not going to be defined by things either. I'm always trying to push and to try to figure out, what lies beneath the curtain? What's the unforeseen risk? By the way, sort of fast forward to that, a few years ago, 5 years ago, I took my mom to her 50th reunion from law school. The other 4 women were there as well. And to a person, every man in that class that was there came up and said how proud you should be of your mother and these other 4 women. And I think it's important because, don't allow people to define who you are, but quite frankly, you're the only person that's putting obstacles in the way of yourself. So whether you're a trader, whether you're an investor, your success, your failure really is predicated on the obstacles you put in front of yourself. Lindsay mentioned that I did the Ironman, I think it's now 6 years ago, August 2012. I'll give you a quick backstory of an Ironman. I'm on the board of directors of the Leukemia Society in New Jersey. Before my first board meeting on our show, Fast Money, we had the 3 guys that were putting together the logistics, the licenses, all the ancillary stuff to put on what would be the first ever New York City Ironman. It took these guys 5 years to put everything in place. And they came on our show, and they talked about how in August of 2012, 2,500 people will jump in the Hudson River in an attempt to become an Ironman. And I'm saying to myself, man, that's pretty cool, but who does this? I mean, these people are insane. Took their card, left the show, and I attended my board meeting at the Leukemia Society a few days later. At that board meeting, at the end of the meeting, a gentleman stood up, talked about how he just survived AML, which has a 16% survival rate, and now he's doing triathlons to raise money for the foundation. So of course the light bulb went off in my head, and I'm like, wow, I just met the 3 guys who are going to put on the first ever New York City Ironman. I bet if they call them, they will give us being Leukemia Society, some spots for the Ironman. These things typically sell out anywhere from 5 to 15 minutes. Sure enough, I made the call, and I was able to get 10 spots for the Leukemia Society. Well, there's a saying in life, no good deed goes sort of unanswered, and I typically should see things. Like I fashion myself somebody that sort of sees ahead and figures things out, but I didn't see this one coming because they called me back and said, you know what, Guy, that's fantastic, but we want you not only to put together the team for the Ironman, we want you to be on that team. So at the time, I'm, I think, 45, 46 years old. I weigh about 239 pounds. I fashioned myself a decent athlete at one time, but I was a meathead athlete. I played football and basketball. I wasn't a long-distance runner. I didn't run, I didn't swim, and I didn't bike. I'd get out of breath walking up a flight of stairs. I don't even know what my blood pressure was. It probably wasn't important. I'm Sicilian, so unless there's a bone sticking out of my arm, I'm not going to a doctor. I'm one of those people. But I'm about to say to myself, you know what? There's a reason why I met these 3 guys. There's a reason why I'm on the board of the Leukemia Society. And I said, I'm going to do it. Everybody, to a person, either laughed at me to my face or laughed at me behind my back. Nobody thought I could do it. Quite frankly, I didn't think I could do it either. But over the course of the next 8 months, I whittled myself down from about 239 pounds to 190 pounds. I got my resting pulse down to 46. and I jumped in the water that day along with 2,400 of my closest friends to try to complete the first ever New York City Ironman. Now, if you don't know what an Ironman is, it's pretty cool. 2.4-mile open water swim, 112-mile bike ride, followed by a marathon, 26.2 miles, and they'll tell you that 0.2 miles is really what gets you. You have 17 hours to finish. They typically start at 7 a.m. and they end at midnight. Little anecdotal story, hopefully you all ate breakfast. The Hudson River is not the most pristine body of water in the United States. It was made less pristine 3 days prior to the Ironman because there was a raw sewage spill in Terrytown, which is north, and the water flows from north to south, and that's the way we were swimming. But the swim went off. I got out of the water in an hour and 9 minutes, which was remarkable. In my day, for me, that was it. The fact that I didn't drown was a miracle. But 16 hours and 19 minutes later, as Lindsay mentioned, I completed the first ever New York City Ironman. Zero business doing that thing. Point is, huge obstacle. I was able to overcome it because if you put your mind to something in life, you absolutely can overcome it. And sort of on another anecdote, we raised almost $700,000 for the Leukemia Society, which I think is in large part why I was able to finish that day, because I did it for the right reasons. As investors, as in traders, if to the extent that there are traders out here or investors out here, or people that think differently than everybody else, you're always going to be challenged. You're always going to be challenged by people who say they know better than you are, or they know things that you don't know, or maybe you're looking at the world differently. You know what? Push back on those challenges. You know, look at the world the way you look at the world. Don't let others define how you're going to trade. You know, if you put on a good investment, it's because you put it on, not because you heard about it on CNBC. If you put on a bad trade or a bad investment, quite frankly, it's because you put it on, not because you heard it on CNBC. So live and die with your own thoughts. And now let's talk quickly about the markets and the environment we find ourselves in. Fast Money is an interesting show. Hopefully some of you folks have seen it. If we make it to January, it'll be 12 years on air, which is pretty remarkable. People ask, how did you wind up on this show? And again, I'll give you a quick story. So I was a commodities trader. I worked at Drexel Burnham Lambert in the 1980s. I left Drexel to go work at Goldman Sachs. I worked at J. Aron, which is the commodities, the fixed income currency and commodities group within Goldman Sachs. I worked with Gary Cohn, I'm sure you know that name. I worked with Lloyd Blankfein. Give you a quick Lloyd story because this is sort of the way he and a lot of the folks at Goldman were wired. They called me up in the spring of '96 and they said, listen, we'd like to come talk to you about potentially working at Goldman Sachs. I said, absolutely, tell me where to be. They said, come down to 85 Broad Street on some random Friday. So I made my way down to 85 Broad Street, the headquarters of Goldman Sachs, and in a room I met with a guy named Jim Riley, who none of you should know. I also met with Lloyd Blankfein, who hopefully all of you will know. And they sat me in a conference room and they said to me, you know, we followed your career. You've done a great job trading gold for Drexel, subsequently AIG. Our gold trader is leaving to go to work in London. We'd love for you to come over. And I said, wow, Lloyd, Jim, this is amazing. It's humbling. Thank you so much. I said to them, do I have any time to think about it? And Lloyd said, looked at me in the eye and said, Guy, you have all the time you need. I just need an answer before you leave this room today. And it was then that I knew that was my first test at Goldman Sachs. That was my absolute first test. Even though I didn't work there yet, I was being tested. And I said, you know what, Lloyd, you're right. When do I start? So I trusted my instincts. I find in life, and I believe this with all my heart, I think we're all born with great instincts. I think the only time we get ourselves in trouble in life, whether it's athletically, educationally, personally, relationship-wise, or investing-wise, is when we fight against our instincts. I think we should always trust our instincts. I trusted mine that day, and it got me into J. Aron. Now, at J. Aron at Goldman Sachs, nobody goes on TV except a few people, and I was never on that course. I was also not on the course to be a partner at Goldman Sachs. You're either on the partner track or you're on the Guy Adami track, and I was sort of on the Guy Adami track. When I was there were 6,000 people at Goldman Sachs, and everybody thought they were going to be partner. The reality is that wasn't going to happen. And at a certain point, you have to make a decision there. You're either going to stay in your current role, or you're going to say, you know what, I'm not on the partner track. Maybe I can lever this and move on. I chose the latter. I levered it and moved on and went to work at a place called CIBC. Within one of my first few weeks at CIBC, CNBC came in with a camera crew, and Bertha Coombs was the anchor that was there. We were doing our charity day at CIBC. And they came in and said, we'd like to interview a few traders during the day. Nobody wanted to do it. So one of the guys came up to me and said, Guy, look, we'd really like you to do this. Nobody wants to do it. Would you mind going on CNBC? I said, yeah, sure, I'll talk about whatever you want me to talk about. So I went on. I was on with Bertha Coombs. It was Liz Clayman's show. It went pretty well. And a couple weeks later, I got a phone call from Liz, and she said, you know, we'd really like what you did last week. Would you mind coming on sort of a weekly spot? I said, absolutely. That coincided with Jim Cramer's show, Mad Money. Now, as a lot of you folks know, Jim did a show with Larry Kudlow called The Kudlow Report. Show was awful. Why was it awful? Because both of those guys are brilliant, but neither one of them were themselves around the other guy. They were so respectful of each other that it made for miserable TV. So a woman named Susan Krakauer came to CNBC and said, all right, look, this show is miserable. So this is what we're going to do. Larry, you're going to get your own show at 5 o'clock each day called The Kudlow Report. And Jim, we have an idea for you. And the idea for Jim was Mad Money. So within 6 months, that show absolutely explodes. But in television, it's sort of what's next. So they asked Susan, what's next? And she had been incubating an idea with a guy named Dylan Ratigan about a show about traders. What is a trader? What do they look like? How do they interact with each other? What's their relationships? What do they do when the market's closed? And they wanted to replicate that on a television show. So over the course of about 6 months, from November of 2005 to sort of early spring of 2006, CNBC brought in about 450 people, effectively anybody that ever been on a network in any capacity, to screen test for, interview for, talk about a yet-to-be-named show. They picked me, and they picked 3 other guys. Jeff Mackey was one of those folks, a guy named Tim Strazzini, and somebody who folks know, a guy named Eric Bowling. And Dylan Ratigan was our host. So all through the back end of 2006, we did what is now Fast Money as an 8-minute segment on an existing show. As fate would have it, in September, Larry Kudlow went on vacation. So the Thursday before he was going on vacation, the network came to us and said, we've made a decision. You guys are now going to have Larry's spot next week. So instead of doing 8 minutes once or twice a week, you're going to have an hour-long show from 5 to 6 next week. None of us were journalists except Dylan, and I don't consider myself a journalist now, but we were able to pull it off, and the show went really well. The numbers were great. And by the end of the year, it was pretty clear that we were going to get our own gig. Well, I still had a day job at CIBC, and my firm came to me and said, look, we've allowed you to do this for the last 6, 7 months, but it's untenable at this point. You have to make a choice. And I said, look, I understand that this show, this CNBC stuff, is really great for me, but I also think it could be great for the firm. It's a great way to brand the firm. They didn't see it that way. So here's where trusting your instincts come in as well. I was in my early 40s, 3 kids, mortgaged the whole rig, and I said, you know what, I think you're making a mistake, but if you're asking me to choose, I choose CNBC, I quit. So I left to join a show that might have lasted a week, a month, maybe 6 months, but certainly not a year. Now I tell that because if we make it to January, and I always say if we make it to January, we'll have been on air for 12 years, which is a remarkable run on TV. And what we try to do is help people and navigate. We're not a stock picker show. We try to help navigate the waters. Recall, in 2008, 2009, people were flocking to Fast Money in numbers that CNBC had never seen before. We saw things on a daily basis that hopefully we'll never see again, but quite frankly, none of us had ever seen before. But we helped sort of navigate those waters. What I also think it did, it empowered people. Because for a long time, Wall Street was a place where, don't worry about it, we got it. We're smarter about your money than you are. We'll take care of it. What 0809 taught people is, wait a second, these so-called experts, which I am not, by the way, but they don't know any more than I do. I can lose money just as easily as they can lose money. And I think it empowered people to invest, to trade on their own. It also helped people to ask the right questions and to maybe look at the world a little bit differently. So let's talk about the world real quick, because I share a lot of the same views that the panelists did as well. But I want to say this, I may always been, in terms of my professional career, a half-empty person. I think it's really important to put that out there. I'm always looking for the next exogenous event. I'm always looking for the next shoe to fall, right? Prepare for the worst and hope for the best. And when I played football 100 years ago, if we won a game, that's when the coach would get on us the hardest. Now, the last couple weeks notwithstanding, the stock market's basically only gone up for the last 8 or 9 years. So now's a really good time to point out what potentially could go wrong. October 8th, 1871 was the day of the Great Chicago Fire. It also happened to be the day of a fire in Peshtigo, Wisconsin. To this day, it was the deadliest fire in the history of the United States. Depending on what textbook you read, it killed anywhere from 1,500 to 2,500 people. From that fire, the National Forestry Service was born. And their main job, their mandate, was fire sequestration. Why? Because clearly forest fires were destructive, but they were also very deadly. And if somehow they could sequester fires, it would be in everybody's best interest. And for a long time, they were able to do just that. But what they learned was forest fires are a natural part of the cycle. Old trees burn down, new growth comes up, and that's how the forest survives. Darwinism at its very best. Yes, they're unsightly. Yes, they're destructive. But more importantly, they're necessary. What they learned was trees that had been impervious to fires were now falling victim. Why? Because the fires that were necessary, that were being sequestered, were 5 times worse when they finally did happen. Why do I bring that up? Because in my opinion, that's exactly what's happened with our Federal Reserve. And it started under Chairman Greenspan. He said to himself, correctly, that they would be able to chemistry out or orchestrate out the recession from the cycle. And they were able to do that. But what we learned the hard way is recessions are a natural part of the cycle. And if you don't allow them to happen, bad things will be 10 times worse. And I think in 0809, that was a manifestation of exactly that. But I also believe in my heart that the problems of 08, 09 weren't solved, they were just moved. And they were just moved from the balance sheets of banks to the balance sheet of our Federal Reserve. As I mentioned earlier, I was something called a prop trader. And a prop trader's job is to make bets, and to make bets on things going higher, and to make things on bets going lower. Putting on a position is the easy part. So I'm a huge Giant fan, okay? And you go to the Meadowlands on a pristine October Sunday. You go, everybody drives there. But driving in on these beautiful days, everybody drives in, they're ladies and they're gentlemen. You first, snow after you, enjoy the game, everything's beautiful, it's going to be a great day. And everybody enters as human beings. Then the game starts. Giants go down 17-3. Third quarter starts. Some rain clouds come up. The other team scores another touchdown. Before you know it, it's 24-3. Mid-fourth quarter, everybody decides to leave at the same time because now it's raining. But those same people that went in as ladies and gentlemen leave like absolute animals. So you're not leaving the same way you came in. It's easy to get into the Meadowlands. It's really hard to get out. It's the same way with prop trading. It's easy to get into a position. It's really hard to get out. What's my point? My point is, in my opinion, our Federal Reserve put on the biggest prop trade in the history of mankind. Their balance sheet ballooned to almost $5 trillion under Chairman Bernanke and under Chairman Yellen. What are they trying to do now? Well, they're trying to exit this trade, and they're trying to do it in a way that's going to be non-disruptive. But almost by definition, it has to be disruptive. Now, if you listen to the president, correctly or incorrectly, It's talking about how Chairman Powell and the Fed is moving too quickly. But I ask you folks this following question to think about, and these are not my words. The president has said on a number of occasions, maybe correctly, maybe incorrectly, I don't know, I'm not an economist, I'm not smart enough or humorous enough to be one, but he has said that this is the greatest economy in the history of our republic. Maybe it's true. Unemployment rate just ticked down to, 3.7, 3.8%-ish. Obviously, we've seen wage growth now for the first time, a significant wage growth for the first time in decades. Consumer optimism is through the roof. Small business optimism is through the roof. All those things are true. And until recently, our stock market's been on fire. So maybe the economy is the greatest in the history of our republic. But if in fact that's the case, then why are interest rates still basically at flat? Fed funds and inflation are basically the same thing. We're talking about 0% real interest rates. If our economy can't handle normalization, then maybe the economy is not as strong as we seem to think it is. But what is the economy? And I've said this on the show, and I want you to think about this as well. Does a recession cause a market sell-off, or does a market sell-off cause a recession? And I ask that as a serious question. I think I know the answer. I happen to think it's the latter, but that's what makes markets. Why do I say that? Well, 74% of our economy is driven by the consumer. It's driven by events like this. It's driven by the fact that 100,000 people will probably show up tonight in Baton Rouge to watch the Alabama-Louisiana State game. Half amount of those people-ish will show up tomorrow to watch the Saints and the Rams. They'll all buy beer. That's our economy. People will spend money as long as they feel good about things. What are things? Again, my opinion. All I think consumer optimism is an overlay of the S&P 500. So in my opinion, when the stock market goes higher, people feel better. Now you say, well, wait a second. Everybody doesn't have money in the stock market. That's true. But for whatever reason, whether you have a dollar in the market or not, if the stock market's going higher, you feel wealthier. If you feel wealthier, you're more inclined to spend. If you spend, that drives our economy. So as long as you feel good about things, you will spend. I hear it on the network all the time. The U.S. consumer has never been better. I don't know necessarily about that. I never question the U.S. consumers want to spend. Never underestimate the U.S. consumers want to spend. But should they be spending? Right now, consumer debt to GDP is about 54%, the highest level we've seen in quite some time. By the way, anecdotally again, people talk about corporate balance sheets never looking better. Maybe that's true, but corporate debt to GDP is right around now 50%. My opinion, we have a tremendous debt problem, but it hasn't manifested itself in the market yet because everybody feels so good about things. But if the market were to start to turn, and we've seen glimpses of it obviously over the last couple weeks, if the market becomes a story, and not a story for the right reasons, will people stop spending? Will people say, wait a second, what's going on out there? That's my concern. And while I'm railing against the Fed, and I happen to think, by the way, that Chairman Powell is doing all the right things, I want you to think about this as well. Unintended consequences. History is littered with disastrous outcomes born of great intentions. All throughout history, that's the case. I also think it's the case here. And one of the unintended consequences, in my opinion, of a central bank that's been extraordinarily too accommodative for the last decade, it's made corporate America lazy. What does that mean? Well, I'll give you two great examples. When money is cheap, corporations don't have to really focus and examine their businesses. They borrow money, they buy back their stock, they pay a dividend, the market goes up, they look like geniuses. They don't have to forecast. They don't have to take critical looks because the market's doing it for them. The market's made corporate America lazy. The central bank has made corporate America lazy. You want proof positive? I'll give you two examples, and you know both these companies. Look at General Electric over the last decade, and look where it closed last week. Look at IBM as well. Both those companies bought back ridiculous amounts of stock, but yet didn't focus on their business model. Well, you say IBM, I mean, that was just old tech. All old tech was going to die. No, not true, because if you look down the street at Microsoft, under the leadership of Satya Nadella, they actually were able to make that pivot. So it's not all companies. Some companies got lazy, other companies didn't. The Federal Reserve, in my opinion, did not allow corporate Darwinism to work, and we're starting to see it manifest itself in some of these companies. So I don't want to leave you all doom and gloom. You know, I do believe in the United States and our entrepreneurial spirit. My biggest concern is the central banks, our Fed specifically, has curtailed and sort of squashed that over the last few years. I think we're in for a heightened point of volatility, but I also think it's a great time to look at your portfolios and to ask the tough questions. Hope is not an investment thesis. Thanks for having me, everybody. I appreciate it. Enjoy the conference.